Friends, I welcome you all to our second session on money market. So previous sessions, we have covered some of the instruments which are dealt in money markets. They are popularly called as money market instruments. We have not covered what are the institutions. We have also covered that thing. So partly various institutions which participate in the money market, that also we have covered. So let us quickly recapitulate what we have learned in the previous class. After that, we'll move ahead. So sharing the screen with you right now. So previous class also I was telling you about this thing, that money market is that component of the financial market where very short-term securities are traded, short-term financial instruments are traded. So on the basis of durability of the instruments dealt in the market, we can classify the financial market in two categories. One, money market, and the other one is capital market. Money market is a market for short-term transactions, short-term securities, or short-term financial instruments. And capital market is the place where long-term financial securities, long-term transactions, or long-term instruments are bought and sold. And here short-term means up to 1 year, and long-term means more than 1 year. Examples, we have seen some money market instruments like treasury bill, bills of exchange, etc. In the previous class we have discussed. And in the capital market, the instruments which are bought and sold are shares, debentures, bonds, etc. Okay, so depending upon the instruments type which are dealt, money market can have components, subcomponents like call money market, where call money is traded, treasury bill market, commercial paper market, commercial bill market, CD or certificate of deposit market, like this. So these are in fact various money market instruments: call money, treasury bill, commercial paper, commercial bill, certificate of deposit, etc. We have discussed in the previous class. And the previous class also I had taken you to the website of Reserve Bank of India. Today also, let me take 1 second, take you there. Give me 1 more second. I think you are now seeing the Google browser, Chrome browser. So I'm taking you to the website of Reserve Bank of India. So if you go there, you can find out the money market trend. So this is in fact, you are seeing. Are you seeing it? RBI homepage?
Yes, sir.
I want to see the money market trend. Tell me, where should I go? Trends in money market, what are the rate of return in money market? I want to understand this thing. Can you tell me where should I go?
Sir, market trend.
Sir, policy rates.
Policy rates. So policy rates will tell us certain rates. Okay. Other reply was about the market trend. If you go to the market trend, you can find, you see, money market rates. And finding out call rates, just you should have this thing in your mind. At least you should know that call market rates are around this range. That is 1.95% to 3.45%. Here you see the treasury bill rates are also, if you have an idea, it varies from 3.44 to 3.81%. Okay. And short-term government securities can also be regarded as money market instrument, even if it is in the government security market. It is RBI has categorized it like this. RBI has categorized this as money market, government security market, and capital market. But what we are doing, these short-term securities like treasury bills, etc., we are considering as a part of money market. Okay, these are called as the government securities, or the G6, or also they are called as the gilt-edged securities, G6. So this is government security market. Coming to capital market, which we'll be learning later on, these are called as capital market. Okay, and some of you told about this thing, policy rates. Policy rates are different, like repo rate, reverse repo rate. You see, you can find out here. Policy repo rate, reverse repo rate, marginal standing facility rate, bank rate, you can find it out here. Okay, so these are certain things through which, or you can say these are the levers through which RBI controls the economy. Okay, RBI manages the liquidity in the economy by adjusting this repo rate, reverse repo rate. It has impact on liquidity. It has impact on the cost of capital. It has impact on the bank's profitability. Okay, and reserve ratios, as previously also we are discussing about cash reserve ratio and statutory liquidity ratio. So you should have this idea. Okay. Okay, and here you can see one more thing: calendar for auction of Government of India Treasury bills. You see here, you know, our previous class also we are discussing that Treasury bills are sold on auction. So you see nowadays 3 kinds of Treasury bills are available, and these are the future dates when it will be auction. Okay, so you can find out various dates in which it will be auction. Are you finding out? Are you able to see it?
Yes, sir.
Okay. So when it is going to auction next? Can you find it out? Next
6th
auction.
October.
Date of auction is 6th October, is to be issued on 7th October. Okay. Okay. So now if you notice, if you check it, you can understand easily that you see auction dates are normally on every Wednesday. And the issue dates are normally on every Thursday. You can have this much of idea that this is how Treasury bills are auctioned. Okay. Now, yeah, what are the functions of money market? We had already discussed. Okay, money market instruments, they're high liquid, all these things we discussed. And you know, call money is the very popular among this money market instrument. And these transactions are valid for 1 day to 14 days. If it exceeds 14 days, we know, call it as the, or it normally call money is for 1 day. If it is exceed 1 day, it is called as notice money. If it exceeds 14 days, it is called as torn money. These things we have discussed in the previous class. So banks and other financial institutions, to meet their temporary mismatches of bond, they participate in the call money market. They invest and they also borrow money from call money market. Banks, in order to meet their CRR and SLR requirement, CRR insists that certain percentage of their assets should be kept in cash, and SLR requires that certain percentage of their assets should be kept in government securities only. To meet the requirement, they may be needing funds. They take it from call money. And to meet the sudden demand of funds, they also use this call money. Like this, these are the various uses of call money. If it exceeds 1 day, as I told you, it is called as notice money. If it exceeds 15 days, or 15 days or more, it is called as torn money. These are the participants, mostly central bank, commercial banks, primary dealers, and various financial institutions like LIC, UTI, GIC, IDBI, NABARD, ICICI, mutual funds, etc. Advantages we had discussed in the previous class. Okay, call rate, you know, then the treasury bill market, government security market, these are issued by Government of India through Reserve Bank of India. As you have seen, 3 kinds of treasury bills are sold: 91 days, 182 days, and 364 days. It is sold on auction basis. Just now I was showing you the dates of auction in the RBI website. Okay, it is sold at par and redeemed. It is sold at discount and redeemed at par. The difference is, in fact, is the interest. These are the advantages we have discussed about the treasury bill. Yeah, so one more kind of money market instrument is the bill market, or the bill, commercial bill or discount market. Here what happens? On a pure commercial transaction, when one person supplies something to the other person, let us say A is supplying something to B, or A has sold something to B. Now A can draw a bill of B. B will accept it. Once it is accepted, A can take that bill, go to a bank, and get it discounted. Okay, by doing so, we will be able to get some short-term funds. So that bill, that commercial bill which is discounted, will act as a source for generating short-term funds. So that can be called as a short-term or money market instrument. It is also referred to as a discount market. Okay, or the transaction is called as the bill discounting. So bills, normally period of bill varies from 3 months to 6 months. So it will give short-term funds. So that is one market, one kind of financial instruments. Right. Acceptance market is also again connected to bill market. You can say it's a part of bill market. So in this example, previous example, I told you that A will draw a bill which B will accept and it will be discounted in a bank. But if the party B is not financially sound, then his acceptance will become meaningless. Bank will still not discount that bill, considering that that party is not financially sound, he cannot be able to pay the bill. So in that case, what is required? This bill may be accepted by acceptance house. After that one, the bank will be discounting. So now what happens in our country, this acceptance house or the acceptance market is not very popular. But it is an international concept where bill can be get accepted by acceptance house and thereafter it can be discounted and it can be monetized. Okay, advantages we had discussed in a previous class. Okay. Now, commercial paper. This is a very important money market instrument. These are issued by companies. Okay, companies means those companies who are having good credit rating, these are financially strong. They issue commercial papers with a validity of 90 days to 180 days. These papers are sold at a discount and redeemed at par. If the company wants, the company can buy it back. So company sells commercial paper, investors buy it. Okay, buy it at discount. Company redeems it. Okay. But the issuer company should be approved, should have been approved by Reserve Bank of India. Then only they can issue commercial paper. So through this instrument, the company collects short-term fund at a lesser cost. So company's cost of capital reduces and investors gets more return because return investment is more than the bank's deposit rate. So investors get better return and the company gets short-term funds at a less price, less cost. So this is again unsecured. These are unsecured corporate debts issued at a discount, redeemed at premium, received redeemed at the face value. Can be in interest-bearing form also. Interest can be given by the company. Okay. The issuer promises to pay the buyer certain fixed amount without pledge of the asset. Therefore, it is unsecured. Can be issued directly by the company or through a bank or through a merchant bank. Okay. It is simple, flexible. Company can diversify the source of finance. That means instead of borrowing money from bank, it can issue commercial paper at a cheaper rate. Company can also issue long-term funds through issue of commercial papers by issuing it frequently or repeatedly. It gives high return for the investors. Okay, secondary market is also there for commercial papers. These are the advantages. Okay, now one more category of money market instrument is there, which is called as CD or certificate of deposits. It is just like a time deposit or just like a fixed deposit. It is also it is issued like an unsecured promissory. That means company promises to pay back. It is a short-term deposit. It is transferable by one party to another party. Banks and financial institutions are the major issuers. They issue this kind of certificate of deposits. Who invests in this series? Banks, corporates, financial institutions, mutual funds are the major investors. They are issued in bearer form or registered form. Bearer means it is freely transferable. Registered means it will be held in the name of a person. It carries certain interest rate. It can be with discount, issued at a discount on face value. The rate of interest is normally higher than the treasury bill. Denominations or maturities can be tailored can be designed depending upon the requirement. However, it has got poor secondary market. This is the features of certificate of deposit, which is one more kind of money market instrument. It is convenient. It is very. It gives liquid fund, good source of raising fund. It gives high return. These are the advantages. Yeah, one more kind of money market instrument is there that is called as InterCorporate Projector ICs. That means one company will be depositing money against with another. The company, one company might be having surplus fund if I deposit money with another company with which is in need of at a particular rate. Okay, a good corporate or a better rated corporate can borrow money also and give it to some other company. Okay, you can borrow money at a lower rate because its credit rating might be good, and it can invest it with some other corporates at a higher rate. That possibilities are there. Okay, the cost of funds of corporate may be higher than the bank for certain companies. Okay, so this is through this system what happens. If some company borrows from the bank, if the cost of capital is higher, so it can opt for this intercorporate deposits. So this is again a good source or a good instrument in money market. Okay, interbank term deposits. Interbank deposits are between banks. They keep on depositing with a maturity of beyond 14 days and up to 3 months. This kind of deposits are made. Only the specified entities are not allowed to lend beyond 14 days. There are certain entities which are allowed only up to 14 days. Okay, this is called as the interbank term deposit. That is one more kind of money market instrument. Now, friends, this is one more kind of money market instrument called as repos or ready forward. Here I am not referring to the repo rate which I was showing you at RBI website. That is the rate. Okay, repo rate is different, and the repo, what we're talking here as money market instrument, they are different. What is repos or what are repos? Repo stands for repurchase agreements. They are also called as ready forward. Okay, just like accommodation of bill we have understood earlier, accommodation of bill previous class I was explaining you. What happens, party A may draw a bill against party B. Party B can also draw a bill against party A. If you want, I will explain you one thing. How in short term money can be generated through the process of accommodation of bill. Let us say there are two parties, A and B. Okay. A can draw a bill on B. B will accept. A will draw a bill on B, and B will accept it. Okay, and this can be discounted with a bank. And bank can give money to A. Okay, A has drawn a bill on B. B accepted. Then A discounted the bill with the bank and bank. At the same time, B can also draw a bill on A. Now A accepts. Then B can give that bill to his bank. Okay, and bank will give money to B. Did you understand? First case, what has happened? A had drawn a bill on B. The same bill is discounted with the bank and money has come to A. A has drawn, A has got. Second case, B has drawn, B will get one. But B has drawn a bill on A accepted. The same is gone for bank for discount and bank gave money to B. So you see, through this process, if this may not be a genuine trade transaction, but this is an artificial transaction or called as a win transaction or tight transaction. Here what happens? Both the parties on each other has drawn a bill and discounted the bill and got money from the market. This is called as accommodation. When you are talking about repos, it is something similar to that. Repos are ready forward or repurchase agreement. Let us see what happens there. Repos are this thing. It is, of course, it is, you can say, it's simultaneous sale and purchase agreement called as repo. It is safe and convenient form of short-term investment. Suppose party A needs short-term bond and party B wants short-term investment. Then party A sells securities to party B at a certain price, and simultaneously agree to repurchase the same after a specified time with a slightly higher price. So A sells securities to B and at the same time agrees to repurchase it at a higher price. The difference between two prices represents interest cost for party A and interest income for party B. So for party A, it is a cost because he has to pay a higher price. For party B, it is an interest income. In this situation, party A is doing repo and party B is doing reverse repo. Did you understand the concept? Simultaneously, there is an agreement to sell and repurchase. Suppose it will be sold at 1,000 rupees, it will purchase at 1,011. Okay, when you're purchasing at 1,100, so 100 rupees extra you are paying. That is your cost of funds. For the investor, that 100 rupees is the interest income. Okay, to explain you this thing, let me show you this example. Now you see here. Let us say there is a party A, who is in need of, he needs money. And one more party B, who wants to make short-term investment. So one party needs short-term funds, another party needs short-term investment. So they can devise, they can generate an instrument, okay, called a security. Now party A will sell that security. He is in need of funds, so he'll be selling. Who will buy it? It will be bought by party B. Party B will purchase that security. Now money will come to party A because party B is purchasing, party A is selling. So money will come. Okay, so now the problem is addressed. A got money and B wanted to invest, he got investment. Now how to repay it? Now what will happen on a later date? Maybe after 6 months. The same security. What will happen? Same security will be, B has purchased, now B will be selling that at a higher price. Let us say he has purchased for 1,000, he will be selling it as 1,100. The extra 100, he will got it for the return on his investment. But who will purchase? That will purchase by A. This is how repo works. This is called as ready for work. I think you have understood the terms. Okay. This is about working of repo. You can have a look at the chart once again. Are you getting? I repeat once again. Party A is in need of fund. Party B wants to make investment. So party A sells a security to party B, and the same security on a later date is purchased by party A from party B. Party B sells and party A purchases. In this process, person who was needing fund, he will pay a little extra, that is the cost of fund. Person who wants to make investment, he will be getting little extra, that is the reward for investment. Who uses it? Banks invest their surplus money. It's a good money market instrument. It gives good return. It can help the borrower to raise funds at a better rate, sometimes to meet the SLR and CRR requirement deficits. Banks may go for this kind of mechanism. Okay, these instruments are highly liquid. Depending upon the requirement, it can be adjusted. Okay, as I told you, the repo rates are different, which appears in the RBI side, as we are seeing at the beginning of the class. Repo rate is different. Repos as an instrument are different. Repo rate is the rate at which banks borrow money from Reserve Bank of India. We have broadly understand that why banks need money. Again, to meet their CRR, SLR requirements, for bond requirements, they can borrow it. What is reverse rate? Reverse rate is the rate, you can say it's the return the banks add on excess funds parked with Reserve Bank of India. So when they deposit, they get a rate which is called the reverse repo rate. And when they need money, they get money from Reserve Bank of India at a rate which is called as repo rate. So always you will find out the reverse rate is less than the repo rate. So that's understanding you should have. And you can check it off at any time by visiting RBI website that what is this rate. Today morning I had Sony, but you keep on track with that. So normally that is reviewed mostly in quarterly basis, and it keeps on changing also. Yeah, yes, friend. These were about various money market instruments. Now quickly we'll be covering about the institutions, various money market institutions. These are the institutions which participate in the money market. One is central bank. As you have seen, Reserve Bank of India plays a very dominant role in money market. It's the guardian of money market. Various instruments which are issued in the money market are monitored by Reserve Bank of India. Commercial banks, they do participate in the money market. They are the participants. They buy those kind of instruments. They also invest in these instruments. Okay. So they are one more participant. NBFCs, so non-banking financial companies and non-banking financial intermediaries, they also do participate in money market instruments. If they're having surplus fund, they can invest it for a very short term period, and they may also collect money from the market. Discount houses or bill brokers, they are in fact intermediaries between the borrowers and lenders. They also participate. They are called as the bill brokers. People are in need of certain money. People want to invest money for certain purposes. So all these things are done through these brokers or discount houses or the bill brokers. Acceptance houses. This is again one more institution in the money market. Okay, they act as agents between exporters and importers, and also between lenders and borrowers, borrower traders. They also act as intermediaries. So these are various kinds of participants I told you: central bank, commercial bank, NBFCs, discount houses, acceptance houses. Friends, you have to remember that all these institutions do not work in isolation. They are not independent, rather they are interdependent and interrelated to each other. RBI monitors, banks participate, bank, discount houses, these bill brokers helps them to find out buyers and sellers. So all of them work together, and in the functioning of money market, all of them play a very important role. As you have seen, one more component of market is there, that is government security market. We have seen it in the RBI website. Here you see short-term as well as long-term government securities are traded. Okay, short-term components can also be called as the money market instruments like treasury bill, etc. We have already seen it. So this kind of instruments which are dealt in government security market are called as G6. In RBI website, you have already seen. They are also called as the gilt-edged securities. They are also issued by Reserve Bank of India. If you see here, once again, if I would like to show you, if I take you to RBI homepage, you can see it. If you go to the market trends, so this is, you see, typically this is the money market, this is the government security market or G6. Below that you are finding capital. Okay, now who regulates these markets? So primary regulator is Reserve Bank of India, of course, ministries, various finance ministry, Ministry of Corporate Affairs, and other regulators also helps in regulating this money market. Friends, I think we got a fair idea about money market. Do you have any query? Then let me know.
No, sir.
Okay, thank you. Thankfully, there is no query. So what we'll do, the next class will catch up with the concept of capital market. And there again, two things we'll be talking about. One is primary market, second is secondary market. Then what is that capital market? Why at all people go to capital market instead of money market? What are the advantages? What are the disadvantages? And what is the distinction between this primary and secondary market? What is the use of this market? All these concepts will be learning. So in the meantime, you can keep on visiting to the website of Reserve Bank of India, try to find out this kind of market trends. You can also see the trends in the capital market by referring to the RBI website, or you can go to certain stock exchanges website like BSE site or NSE site. You can visit to understand the market trends. Thank you very much. We are going to catch up in the next session. Thanks a lot.
Thank you, sir.